What's going on, everybody? Liam O'Reilly, Vermont economic realtor. Today is, what day is today? The 12th of October. Federal Reserve just released their minutes from their September meeting, which happened about a month ago, 20 days ago. And there's some interesting stuff in there. So I wanted to talk about that today, talk about the minutes. I just read through them. And talk about the implications in the housing market, specifically here in Vermont, correlate that to what I'm seeing, and just give you an update based on what the Fed was thinking 20 days ago, and where that could take things. So what the Fed said is, in their press conference, they said that their main focuses are achieving the 2% inflation target and maintaining a solid job market, not having too high of a rise in unemployment. So something else that happened earlier, either it was this week or I think it was last week maybe, the jobs report came out, and the amount of available jobs dropped by, I think it was 1 million. It was at 10 million or 11 million available jobs. And it dropped down to 10.1 million, something along those lines. It was a significant drop in available jobs on the market. So something else that's interesting is the unemployment rate drops. So as these rates are rising, the unemployment rate is still dropping, which might seem counterintuitive, because as the unemployment rate, or as the Fed funds rate rises, it makes it more expensive for businesses to get loans. And then because it's more expensive for businesses to get loans, to get money, it's harder for them to hire and expand, especially when the economy is starting to restrict and contract. So what that means, the fact that the unemployment rate dropped, is a good sign for the Federal Reserve that they can keep raising rates without much of a risk to short-term unemployment skyrocketing. However, when they raise these rates, it doesn't affect the job market and the economy immediately. It takes time for these higher rates to filter through these businesses, for these businesses to adjust to these higher rates and start operating their business at that fashion. So what they're doing, it usually takes 6 to 12 months for that to happen. So the rate hikes that they've done, we're just now seeing the effects of what happened 6 to 12 months ago in those rate hikes. So this decrease in available jobs in the market is from when they raised rates before, and how those affected businesses and how those businesses operated to today, if that makes sense. So that's the effect. So a big thing to watch is how the available jobs decreases over the next few months. At least I think it's going to decrease, but I think as long as that number stays high and the available jobs stays high, then the Fed is going to feel much more comfortable raising rates and staying aggressive with their policy. The other thing that they said in the minutes here, which they mentioned in the press conference as well, is that the inflation remained unacceptably high, were their words. So they're still aggressively fighting inflation. I think that's no surprise to anybody. So that's what they're doing. And as long as unemployment stays high, they're going to keep raising rates, trying to fight inflation. I don't know. I don't know how well it's going to work to actually bring inflation down. They mention here in the minutes that their exact words, supply conditions might not improve as much as expected, and energy prices might rise sharply again. And they state that their predictions for inflation could skew to the upside because of these supply issues. And as they raise rates, it makes it harder for businesses to expand and to hire people, like we talked about, which might make it more difficult for the supply side to catch up, which seems like what's really causing inflation is the skewed supply issues. So with those indications, we could, or based on what the Federal Reserve is saying here, they could continue to raise rates. There's plenty of room to go on the job market, so there's not a huge risk, at least at this time, in the short term, of a lot of unemployment because there's so many jobs available. But at the same time, they could raise rates and it might not be as effective as they're hoping or as they're predicting, which might cause them to raise rates more, which means they could overskew because there's a lag from when they raise rates to when those rates affect the economy. Something else that they talked about, and getting over to the housing market, is they said here that, sorry, I have the paper here. Credit in the residential mortgage market remained available for high credit borrowers. So the most well-qualified people can still get a loan, they can still buy homes, and they're still out there. And that's, that's what I'm seeing here. It says credit availability for low credit score borrowers continued to ease through July, but remained modestly tight. So basically what we're seeing in Vermont and what the Federal Reserve is saying is that, based on the data that they're seeing nationally, the people that can afford a home and are well qualified, high credit score, high income earners are having no problem purchasing a home. But the people on the lower end of the spectrum, lower credit, not as well qualified, it's still tough for them to get a property, either because it's tough to afford because of the high interest rates, or it's difficult to compete against these higher income earners for the properties that they're interested in. Whether, at least here in Vermont, I know the under $300,000 condo range, which is, just a few years ago, those would have been under $200,000 at maybe a 4% interest rate, 5% interest rate. Now it's $250,000, $275,000, $300,000 for some of those starter condo homes. And there's a lot of competition with cash buyers coming in, purchasing it for their kids who can come in and get a mortgage after, or purchasing it as a rental, something along those lines. So that's what I'm seeing here in Vermont. It's still very competitive. Inventory is still very tight. The supply side of the housing market, just like how they said the supply conditions might not improve as much in the economy, and energy prices could increase, the supply side of the Vermont housing market is the issue. And what they're saying here, supply conditions might not improve. I think that's true of the Vermont housing market as well. As these rates rise, things are getting tough, things are getting tighter. If energy prices rise too, that's just going to put more constraints on people. The jobs might start to restrict. Hopefully that forces people out of not productive jobs and not productive companies into companies that help the supply chain, help alleviate some of this pressure. But I don't know if that's going to happen. It sounds like the Federal Reserve is going to look at the unemployment rate, going to look at the jobs available, going to say that we have plenty of wiggle room, we can keep raising rates, inflation's still high, we're going to keep trying to fight it, raising these rates, and they're not going to be too worried about it. But they said here as well, regarding the unemployment rate, that unemployment rate, right here, they commented that the unemployment rate could rise by considerably more than in the staff forecast. So rates, it sounds like rates are going to stay high, and unemployment could way overshoot what the staff is forecasting. They're expecting it to rise a little bit, but unemployment could go way up, and at that time, the effects are gonna already be in place. And I think when unemployment is that high, I think that's when the Federal Reserve is going to flip and start to relieve pressure from these rates, and things are going to start to drop. But at the same time, it's not going to be a good sign for the Vermont housing market, because right now demand is shrinking with these higher rates, and it's going to continue to shrink as rates continue to grow, which is going to hurt first-time home buyers and people that aren't as well qualified, but it's going to reduce some of the competition out there. Right now, there's still a lot of competition, but it's going to reduce some of that. And if unemployment rises, you know, so that's going to affect some of the higher income earners as well, but it's also going to affect the lower income earners. And when rates drop because unemployment is high, the people that are going to be able to take advantage of them are people who have well-paying jobs, people who are well qualified. These high income earners, they're still going to be at the top of the pecking order, and the people are going to, the demand is going to rush back into the housing market, where we haven't had this big expansion of supply. At least I don't see where the expansion of supply is coming from. There's not a whole lot of homes being built. There's not a whole lot under construction right now, and buyers are starting to run away from the market. So there's not a huge incentive for builders to make new homes. So it's kind of a tricky situation. Once those rates start to drop, it's just going to bring more buyers in to what's already an undersupplied market. Anyway, I hope that makes sense. I guess the main message was that there's plenty of room to go with the available jobs in the economy, and unemployment is still high. They're trying to get it down to that 2% target. So it doesn't seem like rates are going down anytime soon. If you talk to some lenders, they might say that rates are going to go down in the beginning of 2023 here. But I personally don't think it's going to happen based on what the Federal Reserve is seeing until we get inflation down and we get a big uptick in unemployment. So I hope you guys got something out of it. If you're looking to purchase a home or sell your home here in Vermont, still a great time to do it. It's tricky waters. Happy to help you navigate it. All my contact information should be in the description or in the description of this channel. Reach out and let's chat. Thanks, guys. See you later.